era, they were all, at the end of the day, data businesses, and their business models were based on controlling access to data to a degree through their interfaces. And so that was the basic logical conclusion that in Web2, most of the value accrued to the applications built on top of the internet protocols because those applications house the data in their private servers. But in Web3, most applications built on top of protocols that house the data themselves, and that data is owned by a broader set of participants, and then therefore the value would accrue to that layer instead of how it played out on the web. Lots of things have changed since then. There's been a really fascinating discussion as the years have gone by around the validity of those ideas. I think currently the data still suggests that most of the value is on the protocol layer, although all of the structural changes that we've had in terms of the technology raise really interesting questions about whether that is likely to continue being the case.
I think Chio will have some comment on that. I would love to hear your position. Sort of read your article, but just tell us about it, and then we can go to Alex next.
Yeah. Yes.
Here you go.
We have one magic mic, and we just alternate.
Cool. Yeah. Thank you so much for having me, and immense privilege to be here on this panel with people whose work I've read when I first entered the crypto industry. So this is really exciting for me. I think I came at the situation from a very different lens where I was a traditional fintech investor, and what excited me a lot about blockchain and crypto is really the ability to build global permissionless rails that are fundamentally better than what we had. And so for me, there was always an inherent tension about the idea that we were investing and building rails that were inherently better, but somehow were able to capture supernormal profits over what we saw in traditional rails. And that contradiction for me led to, I think, focusing on some of the recent developments and improvements on the rail side that would eventually compress value capture over time. And so I think that the FAT protocol thesis was very evidently powerful and true back in the day when ETH was really the dominant L1, where there was a lot of belief that value capture would exist in that perspective, and a lot of, I think, funds were very interested in pursuing that thesis from a returns perspective. And I think for the longest time, and to some extent till today, that's remained true. I think that the trust of my examination was really around the impact of rollups, the success of alt L1s. I think at the point of publication of my article, which was, I think, March 22, when Solana certainly posed a much bigger threat. And really competition for kind of block space between ETH L1 and L2s, as well as the re-examination of whether or not dApps were necessarily easily forkable. I think that was one of the central ideas at the time, that the moat for dApps was far thinner than it was in Web 2. I think that to a large extent, dApp moat does exist in the form of kind of brand distribution, liquidity, network effects, especially in the context of the ability to very quickly multi-home. And so the ability, I think, for dApps to prevent value from being captured from the underlying rails as opposed to keeping it for themselves, I think dramatically increased in those past few years. And so I think some of these structural changes that Joel has also alluded to, I think has created a very interesting situation. And so I'm leaning kind of more against, more towards kind of the FAT dApp theory as opposed to FAT protocol theory.
Yeah, so just to quickly recap a couple of key points being we have cross-chain, one dApp can get deployed to multiple chain. We also have rollups that essentially reduce the fee accrual to the base layer, two of you mentioned. What about Alex? What do you think?
I think this one works. Yeah, so we've been investing in both protocols and applications for the last 5 years, and so this has been a raging internal debate for that whole period of time. I think you can argue both sides, and where I probably shake out is, and perhaps we'll agree to some extent, Joel, but I think I recall listening to one of your podcasts a few years ago when you said that the post had been written to imply that maybe it was the vast majority of the value would accrue at the protocol layer. But in reality, it was probably a little bit more nuanced than that, and the applications would take a larger share. And I probably fall on that side of things. I think that, on a risk-adjusted basis, given where we are today, the protocols are a really good way to get exposure to the growth of the ecosystem. They provide basically an indexed bet on all of the applications that come on top. The widely used ones, and Ethereum in particular, is minimally extractive, and that's a part of the reason that people use it, but it's highly defensible and has a really strong network effect. Applications, on the other hand, are exposed to much more competition, but have better economics. And so if you look over the last year on chain, the biggest two applications by fees generated, OpenSea and Uniswap, they did about generated about 60-something% of the fees that Ethereum did as a whole. So I think the direction that we're headed in are that applications in aggregate are almost certainly going to accrue more value. But if I were to guess, the most valuable single asset will be the protocol asset. So I probably skew a little bit more towards applications, but as an investor who's looking to get really good risk-adjusted exposure to the growth of the ecosystem, I think the safer bet today, we don't know what the top 5 applications are going to be on Ethereum in 10 years, but I have a lot of confidence that Ethereum is going to be a really important network in 10 years. And so you get kind of a safety premium. And I would argue that the quality of the fees generated by Ethereum, by nature of its diversification across the whole universe of applications, are higher quality than the more volatile fees that you'll see from an individual application.
I actually love the analogy of index. There are less sort of ETF fund on the market than it is for stocks. And if we draw the parallel of dApps equivalent to more of the stock picking, and then L1s more like indexing, then yeah, it is more risk adjusted. I guess the next question, and kind of the sticking point of how we want to define, how we want to argue this, is the definition of what constitutes a dApp versus in protocol. And especially now we have more middle layer or more of the developer platform where they want to become a protocol on top of which dApps build, but then they are also a protocol. So where do those, like Lens protocol, where do they fall in the fat protocol thesis?
If I may start, but also referencing some of the answers that my colleagues gave here today, and I think that'll help transition into those definitions. Or maybe starting with the definitions, at least the way I think about it, and the way the post was written, although sometimes it can be a little lost, is I really think about the protocol layer and the application layer. So it's more of a macro view rather than a protocol by protocol or application by application assessment. And the basic observation being all of the protocols combined will be more valuable than all of the applications combined. So what's different now versus at the time is we didn't have that many protocols, and so there weren't that many case studies to explore. As we've touched a little bit here, the infrastructure on the protocol side has evolved quite quickly, and now there's multiple protocols which are often combined with each other by the application layer. And so to properly review that thesis, I think we ought to take the summed value of all of the protocols that a given application is using and then compare it to the sum value of the application. So for example, to take the example of OpenSea, which generates quite a lot of fees, really we have to look at, okay, OpenSea is built on top of Ethereum fundamentally, and now they support multiple chains as well for the NFTs that trade on that platform. OpenSea as a business generates a lot of revenue, which makes it very valuable as an equity business. But if we look at the market value of that company relative to the market value of all of the protocols that it leverages to provide its service, it's very clear that the sum of value of the market cap of all of the protocols is much larger than that of OpenSea itself. Now, I think it's worth delineating the difference between value captured and investment returns, which is, I think, one of the ways in which we can get confused. And may have been in 2021 where I wrote a follow-up called Thin Applications that explored a little bit of the nuances, or explored the nuances a little bit more, where we pointed out that just because a given layer, say in a value chain, captures more value at the terminal state or in the final analysis, doesn't mean that it will continue to exhibit the highest investment returns. And that's really important because it can be easy to mistake the fat protocol thesis for meaning that investment returns will always be higher at the protocol level, and I don't think that's true. And maybe one analogy to explain that is, well, almost everything in the economy, for example, runs on energy, let's say. And so energy companies are immensely valuable and generate a lot of profit, but they're not necessarily the highest return investments at any given point in time. And so what I think happens is that over time, as the protocol layer matures and innovation slows down at the protocol layer, we may end up with a large number of protocols that are heavily used and are highly valuable, but are not longer growing in value at the same pace as the application layer. Now, you can have an application that grows faster in value, and therefore the investment returns are better at the application layer, but standing on the shoulders of giants, so to speak, where you might have trillions of dollars in value captured at the protocol layer, but with relatively small returns. And then the better investments at that point shift upwards to the application layer. In terms of the definitions, I like to refer back to where is the data and the nature of the protocol as being open source versus an application which I think of as being more closed source. So it can still get fudgy, which is why it's so important to define them appropriately. And maybe we can arrive at a consensus today, but I like to think of the protocol layer being everything that's open source, where the data is open and distributed and shared, and the protocol is owned by a community. And the application layer tends to be more businesses and companies built on top of those protocols.
So quick follow-up. Hello? Quick follow-on question to that. Do you see a defined line between dApp and protocol, the top layer and bottom layer, or what does it take for a dApp to move down, become a protocol on top of which you can have an ecosystem thriving on top?
So we can draw it technically, or we can draw it economically, that line. And I know that one of the subjects is, well, what about application-specific chains where you might have an application that then essentially consolidates downwards and builds its own protocol to power it directly. And then the lines might get a little confused. But even in that case, I think that you still have a technical delineation between the application, which we might better think of it as really the interface. The application is how an end user interacts with the services of the protocol. So for example, Ethereum is a protocol, but we all use Ethereum through a wallet. And we connect that wallet to an application, for example. And those are really the user interfaces with which we interact with Ethereum services. Very few people set up an Ethereum node on their computer and send transactions manually to the Ethereum network to use the Ethereum service. And so in that case, I would think of really the application as the interface layer to a variety of underlying protocols.
Thanks for that clarification. It's really helpful. What about Chia and Alec? Any comments to the definition that Joe just pointed out? In your mind, what in one sentence is possible, but you can elaborate, like what's a dApp, what's a protocol?
Well, I mean, I think the line's often blurred, and anything that like a smart contract on Ethereum, for instance, is an application on Ethereum, but it can also be a protocol for its own ecosystem of applications. I think Uniswap is a pretty good example of that, where all of the logic is on chain, and anyone can build their own interface that plugs in. So that would be both, in my opinion, and you could evaluate it as either, but I think both dimensions exist. So it's pretty hard to separate them for the most part. I mean, Ethereum is clearly just in the protocol bucket, but lots of other things are a bit of both. I think something like Lens is definitely both as well. And then you have things like Coinbase that is clearly in the application bucket. So I would probably just categorize them in those sort of three ways, with the middle one being, you could argue, both sides, and they have elements of both applications and protocols.
Yeah, then I'll actually toss this question to Chia. We were just talking in the back room. How do you advise your portcos if they're building on dApp? Do they want to tokenize? Do they want to have a token? And having a token doesn't necessarily make you a protocol, right? But what's the kind of the general guideline, if any?
Yeah, so I think that's a big question, because you're touching on a lot of things in business model, economics, regulations, et cetera, et cetera. So I think it's super contextual. I think where it's related to this conversation is really about, for me, one of the lines is reliance on security guarantees, and that's not super delineated, I think, as mentioned. There are tokens that could be both, and so I think that's kind of where it drives. In terms of the question of kind of what advice do we give for kind of tokens, I think predominantly still very much economic, commercial, and these days increasingly regulatory, and those tend to shape our decision on token launches. I think what we will say is the vast majority of companies in our portfolio at Pantera that have done incredibly well have done so without necessarily launching a token, and it's been able to help them focus on what PMF looks like, and that's been very, very helpful. I think especially in this macro climate, laser sharp focus on PMF tends to be quite helpful.
I think of tokens as a really important tool for coordinating stakeholders in a decentralized network. And if you're not a decentralized network, it is often, I think, an inappropriate tool to use. So if you're clearly an application or a brokerage or something like that, and you put a token in there, I guess my question would be, why is this like making the application better in some form, or is it a way for you to make money at the risk of regulatory enforcement? So I think it's a hard question, because there's always strong incentives to go and bootstrap adoption in any application or protocol with a token, and rushing it out is often the wrong idea. To your point, getting to product market fit first, the way that Compound and Uniswap did, is I think best practices generally speaking. But at the end of the day, is this a system that needs a token in order to coordinate itself in the future, or is it not? And there's a lot of power from an adoption perspective in introducing this kind of thing, but there's also a bunch of friction and problems that you can introduce as well. For instance, governance gets really difficult when you say, hey, everyone's invited to the governance party and we can all discuss what the right way to manage this is. I mean, I think we've all seen how that can potentially not work so well, especially if you're an application that is effectively a startup that needs to move quickly and would like to be nimble. So it can be powerful for the right kind of system, and it should be introduced really carefully.
Absolutely. Let's shift gear a little bit, and I guess I'll go to Alex first, because Blockchain Cap's been investing a lot of modular blockchain, like Fuel, Eigenlayer, even Starkware. So yeah.
ZK Sync.
ZK Sync, yes. So would love to know your thoughts on how this modular trend fit into the value accrual. Like, let's not even just keep saying FAT protocol, just this value accrual. And now within the FAT protocol, let's just say that you're splitting into different execution layer, data availability layer, and then settlement layer. So how does that fit into the picture?
Sure. Yeah, so I guess as context, blockchains are moving towards modular architectures. That's by necessity in large part, I think, because if you look forward and you want a world where we're doing, let's call it like tens of millions of transactions per second on blockchain machines around the world, no single execution environment is ever going to be able to do that in a decentralized context. And so the direction that Ethereum is going and the direction that a lot of other infrastructure projects in the space are moving are splitting up the tasks that make up a blockchain into separate specialized layers that can then efficiently price resources and aggregate a machine that as a whole is much more powerful than any individual blockchain could be. And so typically those layers are execution, data availability, and settlement. And you'll have nodes in the network that run each function and each function alone and are specialized to be able to do that. And so I think that takes the protocol side of the value accrual and splits it up into those three different layers. And I think it's pretty theoretical at this point, but execution is the place where all the economic activity and the transaction ordering is for the most part going to be taking place. And then, one layer down, you're going to have settlement where large batches of transactions are settled, and then maybe really high value transactions are settled as well, where you need strong guarantees around inclusion and timely finality. So my guess is that if you look maybe 5 years out, and this isn't the case today, but we've started to see this ramp up, miner extractable value is going to make up a large portion of the fees that are generated at the protocol layer. So that, for the most part, is going to be captured at the execution layer, and I think that's probably, if I were going to stack rank them in terms of where the value is for the most part going to accrue, it would be the execution layers in aggregate across many different execution layers that are each generating, at some point when there's a lot of economic activity running on blockchains, a substantial amount of MEV. And then a layer down, settlement, I think has a very clear value prop as well. There's a very high willingness to pay if you're transacting with, let's say, $100 million, and you need the strongest security guarantees. And data availability is really important, but I think it has the most challenged case for high pricing power. So I think we're going to find out over the next couple of years what people are willing to pay for data availability, and it's often most important and most demanded in a time where there's a disputed state transition. So I have open questions on that, but I would say, in aggregate, all the execution layers are probably going to capture the most value, and then a settlement layer, and most likely people will use a common settlement layer. There's a lot of good reasons for using one and not multiple, and then we'll kind of see on data availability.
What about, so just a follow-up question there. From an investment perspective, if you invest in modular, you're splitting your fee, but compared to monolithic, at least monolithic, they have three together and you're capturing all the fee. So how do you think about these two school of thoughts? And I'd love to hear from Joe and Chia as well after Alex.
So, I just think we need to go modular in order to scale and in order to introduce new features and iterate at the protocol layer long term. So it's not, I think there's really interesting arguments that you could scale a monolithic blockchain to a sufficient amount, but I think there are strong reasons why that's not going to be the case, and why a monolithic machine sort of inevitably is going to be limited in scale. So I think of it less as value capture and more of like, what is the infrastructure that's needed to power the world's economic activity in 10, 20 years down the line.
Yeah, so I think to answer that question also touches a little bit about the follow-up point that Joel made, which is, I agree with everything he just said, but I think the biggest thing to consider is just very simple economics, which is what is the amount of competition and user optionality that exists across any part of the value chain. And that's just simply how, in economics, we look at, supernormal, normal, subnormal kind of return profiles, right? Just from a value capture perspective. And so my perspective is simply that, well, we are coming up with all kinds of really interesting techniques to fundamentally increase user optionality, which is great. So you have modular infrastructure, you have rollups, you have alt L1s, all of these fundamentally introduce optionality. And if we believe that they do introduce optionality, then there is competition, and competition naturally reduces value capture. And that's, from that perspective, simply kind of how I approach this entire problem, which is this is all great for the users, this should be absolutely encouraged and be built, but we should theoretically see a dramatic reduction in value capture. And the only situation where this would be incorrect would be if the ease of use of infrastructure promotes a disproportionate amount of adoption of those technologies to the extent that value gained by the entire ecosystem far outstrips the incremental reduction of value capture that each individual player can hold. And to a large extent, I think the jury is still out whether that exists. I don't think necessarily that will exist. And so I think, to the point, great advancements in tech, great for everyone, perhaps not so great for individual kind of return on capital.
Yeah, I agree with Alex, and particularly on the changes that need to happen in order to achieve scalability. And then the interesting question about how then is value split between the different layers is one where we get to cop out and just invest in all of them and find out later. And so that's, that helps. But if I had to guess how it might split overall over time, independent of individual winners, because you might think, well, there's a lot of competition, as you were saying, at basically all of those levels, right? And so one exercise is to try to pick the winners on each particular category, which is a subjective exercise. But on the macro side, I would tend to think that value will be split proportional to cost. And what I mean by that is, well, what is more expensive to operate? The execution layer, the data availability layer, or the settlement layer, which I like to think of as the consensus layer. And you can argue it in many different ways. You could say, well, computation is likely to be more expensive than storage and data availability, and you can probably come up with a methodical approach for proving that. And you might say, well, settlement is also kind of expensive to run because it requires the coordination of lots of people and coordinating incentives for agreeing on what the right order of blocks is, et cetera. But I do think it falls along the lines of cost because it sort of makes economic sense, or it follows the laws of economic physics, where if a particular layer is just more expensive to run relative to the others, in order for that layer to exist at all, it will have to capture a proportional amount of value in order for it to maintain equilibrium. And so if we find that we sum all of the pieces and it turns out that half the cost is at the execution layer and the other half is split between the data availability layer and the settlement layer, then it would stand to reason that this execution layer would capture 50% of the value, roughly speaking, relative to the other layers. If we, however, find out that, well, wait a minute, turns out that consensus is really expensive, and so for consensus, let's say that consensus turns out to be 70% of the cost of operation, and then it turns out that data availability is more expensive than we thought because we generate vastly more data than anyone expected, and so storing all of that data becomes increasingly expensive, for example. And then later it turns out that, well, execution doesn't need to be that decentralized, and maybe we have like advancements in technologies, like I'll speculate here, but let's say that something like quantum computing or super powerful computers suddenly make the execution of software incredibly cheap, then in that scenario, we might find that the execution may not be that valuable in the end. And I don't think we have the answer now, and I think the answer will change over time as technological advances emerge. And so, there's at least one world in which the settlement layer is the most expensive and the most valuable, and the other layers get commoditized, but you can make equally valid arguments for why execution might be more expensive and therefore more valuable, or data availability could be more expensive and therefore potentially more valuable.
Do you have a comment?
Yeah. So I agree. I agree that that's like a model of this based on cost is the way that it gets started. And if you can provide lower cost compute, you're going to go compete with the execution layer and try and win all those applications. I think the sort of nuance and the point of the MEV angle is once you get to a certain point with an ecosystem, there's benefits to living on the same execution environment as other applications. And at a certain point, I think you have a strong network effect within an execution layer. And then you have all sorts of different opportunities to capture value at the sequencing layer that results from the ability to order transactions. So if you have, hundreds of exchanges, a bunch of different lending applications, a whole financial system living within an execution layer, then the minor extractable value at that layer starts to become pretty significant. And to me, that's the long-term driver of this, which I think starts to decouple from the sort of like more cost-based model of this. But I think it starts based on cost, and then at a certain point, there's a strong enough network effect, and then minor extractable value starts to become a bigger and bigger proportion of the total value captured at that layer. So I guess I would just I would agree, and then add some nuance specifically with respect to MEV once you have network effects within an execution layer.
Along that vein, actually, that brings to my last question of the panel. You mentioned in one of the podcasts you did, earlier players are rarely the winners. So we have a lot of new emerging L1s, and we have established ones like Ethereum, and now we have modular Thesis where dApps can basically share different layers of blockchain. Do you think we have some winners, or you think the big one just hasn't been born yet?
I hope we have some winners. Number one, but I do think that we've all been doing this for a while, and I probably speak for all of us that, I certainly sometimes stop and marvel at how early things are still. And you can sort of gauge that by how many opportunities there are at the infrastructure layer and how quickly it's changing. And so even though we're talking, for example, about modularity as if it is a fact, the reality is that it's still a very recent innovation, and many of these systems aren't fully in production yet, and we've yet to see the effects of this. And so we're all investors, so we're always looking at what do we think the world's going to look like in 5 years, then 10 years. And it's quite likely that when we sit together again in 5 years and have this conversation once more, we'll be probably talking about technological innovations that will come out in 3 years that we have no idea about. And so I don't think you can draw a line in time and say, well, all the winners have stopped being born at this point in time, and it's more of a life cycle and a circle of life, and wherever there is an opportunity for innovation, someone smart will come in and take that edge. But in general, if we want to get practical, I think that as Alex mentioned, I share the conviction that Ethereum is going to be quite important over the next 5, 10, 20 years, and hopefully plus. And we might get a lot of innovation built on top of it, but Ethereum may remain a winner. And we have other investments in alternative networks that we also think will carve a place for themselves in the market that cater to particular applications or particular developer paradigms. But I certainly hope that there are new winners that emerge over time, or we won't have anything to do. So.
Any comments?
Yeah, I think I echo a lot of what Joel said, especially the last sentence. And so sometimes it feels like it's a self-fulfilling prophecy. But I think one of the reasons I personally came into the crypto space is because I do think everything in crypto has far less of a moat, and that's a feature, not a bug. And so if you do take that philosophy, I think we'll continually see like a ton of great innovations, a ton of great winners continue to erupt. Obviously, some big players with very strong network effects will continue to last for a very long time. EVL1 obviously is one of that. But I think the whole point of crypto, in my opinion, is that there is less of a moat. You can build upon everything, and that's great for innovation and competition.
Yeah, I think my biggest takeaway is Ethereum will stay, will persist, continue to be successful, and there are new opportunities to essentially look at the new L1s. So with that, let's conclude the panel today. Round of applause for our panelists, please.
Thank you so much, Katrina and panelists. That was an amazing panel. Right now, we'll enter a break for about an hour until 1 p.m., but we'll resume the panels then shortly. Thank you so much.